In the world of finance, there are few names more notorious than Bernie Madoff. The former Wall Street investment advisor and chairman of the NASDAQ stock market made headlines in 2008 when it was discovered that he had been running the largest Ponzi scheme in history. Madoff's fraudulent investment scheme wiped out the savings of thousands of people and organizations, including some of the world's most prominent banks, charities, and celebrities. In this video, we'll explore the rise and fall of Bernie Madoff, the man behind one of the most massive financial frauds of all time. Hello everyone, welcome to our channel. Are you ready to learn about the ultimate financial scam of the century? Well, get ready to be hooked because we're delving into the fascinating story of the rise and fall of Bernie Madoff. From the heights of Wall Street success to the depths of a multi-billion-dollar Ponzi scheme, this is a story that will leave you on the edge of your seat. However, it is not only entertaining. As a future entrepreneur, you can actually learn some important things from this true story. So, join us as we explore the life and crimes of one of the most infamous fraudsters in history and uncover the shocking truth behind the biggest financial scandal in modern times. Are you ready to witness the rise and fall of a Wall Street titan? Then like this video and subscribe to this channel, and let's begin our journey into the captivating world of Bernie Madoff. Let's start with how Bernie Madoff grew up. Bernie Madoff was born on April 29, 1938 in Brooklyn, New York, to Rolf and Sylvia Madoff. Before joining the financial profession with his wife, his father worked as a plumber. They established Gibraltar Securities, which was eventually shut down by the SEC. Bernie graduated from Hofstra University with a bachelor's degree in political science in 1960 and briefly attended Brooklyn Law School. Bernie married his high school sweetheart, Ruth Nee Alpern, while in college, and they later created Bernard L. Madoff Investment Securities, LLC in 1960. He began by trading penny stocks with the $5,000 he earned while installing sprinklers and working as a lifeguard. He quickly encouraged family members and others to join him in his venture. After the Kennedy slide flash crash of 1962 wiped out 20% of the market, Madoff's bets soured, and his father-in-law was forced to bail him out. Now, let's find out how he began the scheme. At some point, Madoff recruited investors by claiming to achieve huge, consistent returns through a legitimate trading approach known as split strike conversion. Madoff, on the other hand, placed client assets into a single bank account and utilized it to compensate current clients who wanted to cash out. He paid redemptions by luring new investors and their funds, but he was unable to keep the scheme going when the market crashed in late 2008. On December 10, 2008, he admitted his crime to his sons who worked for his company. They handed him over to the authorities the next day. Bernie insisted that his sons were not aware of his strategy. According to the fund's most recent declarations, it has $64.8 billion in customer assets. Who was also involved in the scheme? Let's find out. When Madoff's Ponzi scheme began remains unknown. In court, he claimed that the fraud began in the early 1990s, but his account manager, Frank DePascali, who had been with the firm since 1975, stated it had been going on for as long as I recall. Even less obvious is why Madoff carried out the scheme in the first place. I had more than enough money to maintain my lifestyle and the lifestyle of my family. I didn't need to do this for that, he explained to Fishman, adding, I'm not sure why. The legitimate parts of the firm were enormously profitable, and Madoff might have earned the esteem of Wall Street elites simply by being a market maker and electronic trading pioneer. Madoff frequently told Fishman that he was not solely responsible for the scheme. I just let myself be persuaded into something, and that's my fault, he admitted, without specifying who talked him into it. I believed that after some time, I would be able to free myself. I believed it would be a short time, but I couldn't do it. The so-called Big Four, Carl Shapiro, Jeffrey Picower, Stanley Chase, and Norm Levy have gotten a lot of attention because of their lengthy and successful association with Bernard L. Madoff Investment Securities, LLC. Madoff's connection with these guys date back to the 1960s and 1970s, and his plan garnered them each hundreds of millions of dollars. Everyone was greedy, everyone wanted to continue, and I just went along with it, Madoff explained to Fishman. He stated that the Big Four and others, many feeder funds, pushed client funds to him, some all but outsourcing client asset management, must have suspected or should have suspected the profits he delivered. Madoff's ostensibly ultra-high returns enticed clients to turn a blind eye. In actuality, he merely deposited their assets in an account at Chase Manhattan Bank, which merged to form JP Morgan Chase & Company in 2000 and then sat on them. According to one estimate, the bank may have gained up to $435 million in after-tax profits on such deposits. As clients wanted to redeem their investments, Madoff paid the payouts with new funds, which he drew by cultivating his victims' trust and winning their faith. Madoff also developed a reputation for exclusivity, frequently turning down clients at first. This technique enabled nearly half of Madoff's investors to benefit. These investors were compelled to contribute to a victims fund to recompense deceived investors who lost money. Madoff put on a show of respectability and charity, enticing investors with his humanitarian activity. He also donated to several nonprofit organizations, including the Elie Wiesel Foundation for Peace and the global women's charity Hadassah. He approached worshipers through his connection with J. Ezra Merkin, an officer at Manhattan's Fifth Avenue Synagogue. According to several versions, Madoff defrauded investors. The SEC had been investigating Madoff and his security businesses intermittently since 1992, which disappointed many until he was finally prosecuted because it was considered that the most damage that could have been avoided if the early investigations had been thorough enough. One of the first whistleblowers was financial analyst Harry Markopoulos. He calculated on an afternoon in 1999 that Madoff had to be lying. In May 2000, he filed his first SEC complaint against Madoff, but the regulator disregarded him. Markopoulos wrote to the Securities and Exchange Commission, SEC, in 2005. Madoff Securities is the greatest Ponzi scheme in the world. Because there is no SEC prize award owed to the whistleblower in this case, I'm turning this case in because it's the right thing to do. Several others believed that if the SEC had been more thorough in its first investigations, Madoff's worst consequences may have been avoided. Using his mosaic hypothesis, Markopoulos discovered various abnormalities. Madoff's firm claimed to be profitable even when the S&P was declining, which made no mathematical sense given what Madoff claimed to be investing in. According to Markopoulos, the largest red signal was that Madoff Securities was generating undisclosed commissions instead of the customary hedge fund charge, 1% of the total plus 20% of profits. The final line was that the investors who pony up the cash are unaware that Bernie Madoff is managing their money. Markopoulos also discovered Madoff was seeking large loans from European banks, which seemed superfluous if Madoff's profits were as great as he claimed. The regulator did not request data on Madoff's trading accounts until 2005, just after Madoff nearly went bankrupt due to a wave of redemptions. He compiled a 6-page list. The SEC drafted letters to 2 of the firms on the list, but did not send them, and that was the end of it. Following the disclosure of Madoff's scam and their tardy response to act on it, the SEC was chastised in 2008. How much money did Bernie Madoff return? In addition to his prison sentence, Bernie Madoff was ordered to repay $170 billion in investor funds. The feds seized and sold Madoff's assets, which included real estate, boats, and jewels. Separately, as of September 2021, the Bernie Madoff Victims Fund, directed by Richard Breeden, had recovered and paid out more than $3.7 billion to nearly 40,000 victims. How did Madoff get caught? Although multiple people warned the SEC and other authorities about Bernie Madoff's scheme, he wasn't caught until he confessed to his sons. When Bernie could no longer meet investors' redemption requests in 2008, he confessed to his sons, Mark and Andrew, who subsequently turned their father over to the police. This is where we end the story of Bernie Madoff. Thanks for watching. Remember to like, share, and subscribe to this channel so you won't miss out on content like this.